Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look in depth at the Reserve Bank's decision early on Thursday to hold the official cash rate at 8.25%. We'll also look at the latest on the credit crunch and some news just through that the New York State insurance regulator is trying to orchestrate bailouts of a couple of key bond insurers. Firstly, the key news at home. As expected, the Reserve Bank of New Zealand has held the official cash rate at 8.25%. It essentially sat on the fence and steered away from any strong signal, one way or the other, on where the next move would be. The Reserve Bank cited more global market turmoil as one reason why it shouldn't raise interest rates to dampen persistent inflation. However, holding rates at the same time as the US Federal Reserve is cutting has widened New Zealand's yield advantage to over 5%, making our currency even more attractive to international investors. Immediately after the Reserve Bank released its statement explaining why it's keeping rates on hold, the New Zealand dollar jumped over half a cent to 76.5 US cents. New Zealand's 2-year swaps rate is now more than 6.5% above the equivalent 2-year Treasury yield, while the cash rate itself is now 4.75% above the equivalent Federal Reserve rate. Reserve Bank Governor Alan Bollard said in the statement that the outlook was consistent with the bank's view of inflation back in December, in which it expressed concerns about inflationary pressures. Despite the fears of a recession in the United States, the New Zealand economy was projected to keep growing well, said Dr. Bollard. However, ongoing inflationary pressures were underpinned by an expansionary fiscal policy and rising food and energy prices, which will be under further pressure with the carbon emissions trading scheme in a year's time. This is at least the third strong warning from Dr. Bollard about the inflationary effects of increased government spending and the prospects of tax cuts on offer from both major political parties in an election year. One thing he did point out is that he'll be watching the Asian and the Australian economies closely. Both are still growing strongly and both have inflation problems. The Reserve Bank of Australia is now expected to hike rates within the next month or two after very strong inflation data yesterday. Bollard said that, on balance, the outlook for interest rates is little changed from December, but the level of uncertainty has increased. So no hint there of where to next, apart from we're on hold. I suspect Dr. Bollard would have made a very good poker player. Now, just a quick update on what's happening overseas with the credit crunch. We're getting news through early on Thursday that the New York State insurance regulator is trying to orchestrate a $15 billion bailout of the two biggest bond insurers, NBIA and AMBAC. Now, regular viewers of this daily briefing will remember I've been warning of the risk that these bond insurers might be downgraded from AAA, which would force the revaluation of $2.4 trillion worth of debt. This would in turn force the world's banks into write-downs of $200 billion. So this is a classic case of the borrower's problem being so big, it's the bank's problem. A $15 billion bailout sure sounds cheaper than $200 billion of new losses. We'll see how this one pans out. The talk of a bailout was enough to turn around the sentiment on Wall Street, triggering a late rally. We'll keep a close eye on this one simply because it has the potential to be even more damaging than the subprime mortgage crisis. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. See you tomorrow.